are you? And where are you going? What do you want?
Hello and welcome to People Making Money. I'm your host, Kevin Bemmel, and I'm here every Wednesday at 10 a.m. Pacific time to talk about job hunting, starting and running a business, and building wealth. So the three key aspects to our financial lives. So today I'm going to be talking about wealth, an aspect of wealth building. And if you've noticed, starting this year, I've been rotating through the three subjects. I found that last year I think I focused too heavily on starting and running a business. I think, because I have in my career for the most part had my own businesses, except for the time I was in the Navy. I default to that subject. And I realized I was shortchanging those of you who don't have businesses, but also those of you who are, perhaps more interested in how do I build wealth? How do I get to the point where maybe I don't have to work, right? I don't know if that's the goal. It's not my goal. In general, although frankly not today, get a lot of enjoyment out of my work. Certainly not all the time. It drives me crazy at times. But even if I didn't have to, I think I would continue to work at least part time because it gives me interaction with other people and all of that. But in any event, so today I'm going to be talking about the topic that I promoted in social media, which is wealth is optionality. Okay, this is something that I've talked to people about in the context of deciding whether to have whether to work as an employee, as a W-2 employee, or have one's own business. And I think a lot of people have the mistaken idea that they'll make more money having their own business. Generally, that is not true. Okay. Now, for any individual, that individual may make more money than they could make working for someone else. But in general, or on average, most people would actually make more money working as an employee than they would having their own business. There's a lot of risk, a lot of expense to having a business, and it takes a skill set beyond whatever skills, experience, knowledge someone needs to have in order to be able to do the work that the business does, right? So being a business owner means, in essence, being a good employee to yourself, but also having the skills to run the business. And so, especially for very high earners, oftentimes the payoff from having a business is much lower than it would be if they worked for someone else, until they go to sell the business, and then they get that big payoff at the sale of the business. Now, there's a lot of you see a lot in social media these days of founders of companies that they become unicorns and they sell for $1 billion or more and that kind of stuff. Keep in mind that those are the very, very rare exceptions to the rules. Most businesses don't even sell for hundreds of millions of dollars, let alone $1 billion or more. And most businesses sell for very modest sums, maybe a few $100,000, maybe several $1 million. But the higher the price point, the fewer businesses there are that sell for that. And many businesses actually have little or no sale value because of the nature of the business. So someone who has a real estate practice as a broker, as an agent, there probably isn't a whole lot of value in that business because the business is you as a person, right? So the key advantage, or at least one of the key advantages of having one's own business, is the flexibility that one gets from having one's own business, meaning that you can, to a much greater degree than when you work for someone else, set your own schedule. You can decide if and when you're going to take a vacation and for how long. So, having this kind of optionality is one of the best reasons to have your own business versus being a W 2 employee. And so, this same concept is true when it comes to wealth building. Not that net worth isn't important. Of course it is. That is the marker by which we determine how well we are building wealth. Our net worth increases, but it is the optionality that we maintain that gives us the greatest opportunity to build wealth. Okay. And that's really the core of what I'm going to be talking about today. So I have, I think, 5 or 6 points that I want to cover, 6 points today that I want to cover that hopefully will broaden this concept for you and also help you understand it deeply so you can see how it can work in your financial life and perhaps make it a part of your approach. Okay, so first of all, let's distinguish between net worth and optionality. So, net worth is a snapshot in time. So, one of the things I find funny about using Quicken, which is the software I use to keep track of, the finances of my business and for myself personally, is uh, when you create a statement of net worth, it asks for a time period, which makes no sense. So my net worth today probably is at least a little bit different than it was yesterday, and that's because I went to the store and bought some large envelopes to mail something to my accountant, right? And so that goes on my credit card because I used a credit card to pay for it, and so the debt that my business owes went up a little bit as of yesterday, right? And so when that credit card debit posts probably today, right? If I were to check the balance on my credit card, it would be higher, and that would reduce the net worth of my business. Okay, so net worth is literally a snapshot in as of a specific date in time. Yeah, and typically, we do we'll do a net worth statement each at the end of each month, the last day of each month, or maybe the last day of each quarter, or at least the last day of the year, right? But in any event, it is that snapshot. Optionality is a strategy. It is an aspect of how we approach building net worth. Okay, so we want to distinguish between how do we know that our strategy is working? Well, we take this snapshot called net worth. Okay, but the not the more important thing, but for the purposes of today's show, the important thing is understanding how to use this strategy. Okay, so optionality really looks at starting now. What is my position with respect to how I handle things going forward? Okay. Whereas net worth is just, this is where I am today. Okay. All right. So, different people have different sets of investments. So, if somebody has, if a lot of a person's net worth is tied up in real estate, okay? Or maybe it's tied up in a privately held business, a closely held company, or restricted stock, right? So all of those are illiquid assets, meaning that getting any cash out of them takes time. And as a result, their choices, or well, not their choices, but their ability to execute on those choices is limited. Okay. As opposed to someone who has, let's say, at least some of their wealth in, stocks, bonds, CDs, mutual funds, money markets. So for someone who has some significant liquid assets, okay, so their ability to respond to opportunities in the future is less limited because they have the cash to use to execute it, or at least they can get it pretty quickly, right? Now, of course, there are situations where we have stocks and maybe the market is down, and so we're reluctant to sell at the moment because we want the market to come back up. I got it. Those are all risks. But the fact of the matter is, on any given day, we can put a sell order in for our stocks, and assuming the market is open, that sell order can go through and we can get the cash. Whereas if we have, let's say, a small apartment building, okay, we're not going to be able to, put it on the market today, right, and get the cash out of it tomorrow. We're not probably going to be able to contact a lender today and get cash and get funds that get that loan funded tomorrow. Now, of course, there are hard money lenders who will fund on very short time frames, but that's very expensive money. Okay, and so to use that money to take advantage of a potential investment, the investment may not work because we may be in negative leverage, meaning that because of the cost of the money we've borrowed is so high, we're actually getting a lower overall return by using that borrowed money in order to make the investment. And if you're not familiar with the concept of leverage, I did a people making money show about it 6-9 months ago, sometime in that time frame. So I invite you to go to my channel, just search for that topic, leverage, and take a look at that show. It's an incredibly important strategy, like optionality, for building wealth. Okay, so optionality means that you're preserving your ability to pivot, to invest, to relocate, even to step back when opportunity presents itself or when risk appears, right? So if you've been following the financial and business news at all over the last few days, right? There's been quite a bit of discussion about what's going to happen with oil prices and gasoline prices, right? We've seen gasoline prices go up, I think about 19, 20 some odd cents over the last couple of days. So now the AAA averages, I heard this morning, was over $3 a gallon, whereas before it was actually under $3 a gallon. At the same time, interestingly enough, the price of a barrel of oil, right, from which gasoline is refined, actually dropped a little bit as of when I was listening to the business news at about 7 a.m. Pacific time, right? So there's additional risk in the market right now because of the uncertainty that's caused by the military action going on in Iran and the larger Middle East, right? And so, and I'm not saying this is what you should do, but you may be thinking, gee, I need to step back a little bit and get my head around the larger picture before I make any moves, right? Well, that may be the right thing to do right now. Okay. Other people, though, may be saying, with all the turmoil, this is an opportunity to make some strategic investments that will pay off once the dust settles, right? In either case, keeping what they sometimes call dry powder, right, cash, it would, especially if you're thinking this is time to make some investments, if you don't have cash, you don't have that option. Okay, so this is where optionality is so important. So really, if you think about it, optionality or maneuverability is really what facilitates wealth building. Okay. Now let me hasten to add here that and I was having this conversation with a young man I met yesterday when I was at the store buying the envelopes. We just struck up a conversation waiting, for the cashier. Uh, I am not one who believes in making rapid investment decisions in general, especially if it's in an area of investing where one is not very knowledgeable. Okay, having said that, if taking real estate, for example, if you're a knowledgeable real estate investor, right? So sometimes opportunities arise and they can be very fleeting. Like you've got to be able to grab them right then and there. To hesitate is to lose that opportunity. And so this is where optionality or maneuverability becomes so important because we want to be able to take advantage of these, outstanding opportunities. Okay, but if we have to sell another property or borrow money against it or something like that, we're not going to be able to do so. And indeed, continuing with the real estate example for a moment, while typically we borrow money when we're buying a real estate, whether it's our personal residence or it's an investment property, uh, there are opportunities that come along where it's such a great opportunity. Someone who can pay all cash is going to grab it if our offer is going to be one that requires the seller to deal with a loan contingency. Okay, so um, this is why optionality is one of the reasons why it's so important. Okay, so um, let's look at the next issue now. So liquidity creates the opportunities for leverage without having to borrow money, right? So if we've got cash and liquid investments, okay, so they give us negotiating power. Okay. That's true in business, in employment, and in investing. And I just gave an example on the investing side, right? So in one of the estates that I'm administrating, so we put a property on the market about 10 days, maybe 11 or 12 days ago. Okay. We've already gotten I believe it's seven offers on this property. It's a house. It's a house in a nice up and coming area. It's a nice little house. Has some nice curb appeal. The landscaping probably needs to be worked on a little bit, but that's not so unusual. Okay. Now, here's the interesting thing. Two or three of the two or three of the offers have an FHA funding contingency. I think two of them do actually. Three of them have a conventional loan contingency, and two of them are straight out cash, right? So if all of them were around the same price, clearly it would be better for me as the administrator of the estate to take an all cash offer because that's a sure bet, assuming I have verification that the buyer has the cash funds. So there would be no reason for me to accept an offer from someone with a loan contingency because I'm taking the risk that they may not qualify for the loan and therefore the transaction falls through and I have to start marketing the property over again. Okay, so you can see where being an all cash buyer on real estate would give leverage. Now, in the event of this particular example, the two cash buyers are trying to lowball the price. They're probably actually looking at the names of the of the buyers. They're investors. They're probably bottom fishing, and if they make 1,000 offers, hoping to get one or two of the properties, right, from someone who's desperate. But if they were offering a similar price to the offers with loan contingencies, clearly I would be better off taking one of those all cash offers. Okay, but leverage that comes from having cash and liquid investments comes in other ways. So, for example, you may have heard the adage, the best time to be looking for another job is when you don't need it, right? And one of the reasons why that's the case is, first of all, when you are meeting with hiring managers, you don't come off as, I got to have a job kind of thing, right? But second of all, you can negotiate from a stronger position because you're not in a situation where you've got to have an income, right? And so you will typically have greater leverage in negotiating a compensation package for a job if you've got some cash and liquid investments. Now, you may argue, well, but I don't want to diminish my savings or my liquid investments, by going unemployed and not having an income. Okay, fine. That's your decision. My point is not that you have to do this, but just that you have the option of doing it. Okay, that's what having liquidity will give you if you're looking to better your opportunity as an employee. The same thing is true of a business. So a business that's operating under very constrained cash flow is a business that is probably not going to be able to maximize its potential. It doesn't have funds available to make investments in technology, investments in marketing, to be able to take the time to work to find desirable clients, negotiate reasonable, favorable agreements with those clients, because they're cash flow constrained. So just before I started this broadcast, I had a conversation with someone I know who, like me, has a small business, and we're looking at working together on one of the estates that I administrate. But the estate has no liquidity in it. And so she wanted to get going on it right away. And I said, wait, before we move forward, I just need you to know the cash position of the estate, because you can do the work, but I won't be able to pay you. I don't know that I'll be able to pay you when the work is done. And here's what else is going on, right? And what I didn't want to do was bring someone into a situation where she didn't understand the potential cash flow issues, and then put her own business in a cash flow constraint because now the estate doesn't have the money to pay her, right? So I wanted her to have the opportunity to make an affirmative decision about her optionality in her business, right? And I think I think we're obligated to do that as reputable people in business, or even as reputable people working for another company, right? To let those with whom we're going to be doing business know, hey, I just need, before we move forward, I need you to know these issues, okay? So the reality is, the ability to say no translates into financial strength. And the ability to say no, to maintain that aspect of optionality, comes from having liquidity, right? So it also, maintaining liquidity means that even during a downturn, we can potentially make investments or make decisions from a broader perspective than others who are constrained because now we're in a downturn and they're in a cash flow squeeze. Okay, so it's important to maintain an appropriate cash flow, or an appropriate, I should say, an appropriate liquidity position, right? So, okay, and then finally, having financial flexibility, it reduces the cognitive load, the emotional aspect of decision making under pressure, right? So if we're cash flow constrained, and let's say our car breaks down, take it to the mechanic, and now we've got this big huge car repair. If we are illiquid, where is the money going to come from to pay for our car repair and get mobile again? Okay, or at least here in Southern California, where having a car is still important, right? So uh, and cognitive loads don't come just from needing money but not, or needing liquidity but not having it. It can also come from missing out on an opportunity. It's like, oh, if I had only maintained some liquidity, there was this investment, and blah 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 blah, right? And we start emotionally kicking ourselves. Okay, so liquidity creates opportunities for leverage beyond the strictly financial aspect of leverage. Okay, next. Income diversification really equals strategic freedom. Okay, so when we talk about diversification in investing and wealth building, we tend to think of it from the perspective of having investments in a lot of different areas, like real estate, stocks, bonds, crypto, gold, silver, right, commodities, whatever, right? That's the kind of diversification we think about. Or diversification in our stock portfolio, where we own stocks, we own domestic stocks, large caps, small caps, international stocks, right? That's also a type of diversification. Okay, but we should also seek in our financial lives some income diversification. Okay, so if we have multiple streams of income, we reduce our dependency on any one stream. Okay, so going back to the topic of having a business versus being an employee, this is one of the key points that I make to people when I talk to them about, should you start a business, should you remain an employee? And that is, being an employee is essentially like having a business with only one client, your employer. Okay, if you lose that one client, meaning you get laid off or fired, your income goes down to zero. When you have your own business, and let's say you've got 5 clients, okay? And let's make a further assumption. Let's say not all the clients generate an equal amount of revenue. Let's say you've got one client that generates 40% of your revenue, and the other 4 generate the other 60%, or about 15% each. Okay, and let's say you lose one client. Okay, let's say you lose your best client, the one that's generating 40% of your income. Okay, but you still have 60% of your income left. Whereas when you're an employee, if you lose your one client called your employer, you have 0% of your income left. Okay, so you can see that even if your streams of income are all coming from the same activity, but you have multiple streams of income doing that same activity, you're reducing your dependency risk. Okay, and that gives you greater strategic freedom. It gives you greater optionality. Okay, now maybe you have diversified income streams. Okay, so maybe you have your primary business, but you've got a side hustle, or maybe you've got an annuity that was left to you by a relative who passed away. Okay, so even if things aren't, even if you take an income hit because you lost your job, or maybe your company is asking you to take a pay cut because it's having financial problems or whatever. Okay, but you've still got this other income stream. Okay. Or maybe you've decided over a number of years, you've accumulated wealth and you decide, hey, I'm going to take some of this wealth. I'm going to buy an annuity to give me an additional income stream. Okay. So again, that reduces your dependency risk. So we can diversify our income in terms of having multiple sources of income for doing the same activity, or we can have multiple streams of income, doing different activities or having different sources for that income. Okay. And so then when one stream slows, or even worse, ends, so we have an ability to adapt rather than panicking. Oh my gosh, I just lost my sole source of income. Okay. So if you, whether you're an employee or a business owner, okay, you may decide you want to have some kind of side venture. Maybe you want to act as a consultant to other people who do something similar to what you do. Or maybe you can get some kind of board position or advisory board position to a company that it does something similar to you, but maybe they're in a different segment of the market or something like that, where you're not working at odds with yourself, but you're able to put your knowledge to work for yourself and for the benefit of another organization, um, at the same time that you continue doing what you're doing. Maybe you've got some intellectual property, right? So I have at least some pieces of intellectual property, these shows, right? Now, candidly, it's very difficult to monetize this kind of intellectual property. My audience isn't big enough yet, but it's growing every day, every week, right? And while it's not the primary reason I do these shows, one of the reasons I do them is to potentially develop another income stream or create another asset apart from my primary business, right? But you may have a parent who composed popular music, right? And they have a catalog now. Maybe maybe it's registered with ASCAP, and so every time one of the songs that your parent or your relative composed or wrote the lyrics for um, plays, you get a royalty or something. There's all kinds of intellectual properties and ways to exploit it, meaning monetize it, I guess would be a better word. And create another income stream. And maybe you have some digital assets that also, in one way or another, create some cash flow. Okay, so all of these increase your optionality. And again, to reemphasize this point, uh, uh, diversification is not just about returns, it's about maintaining choices. Okay, that's where diversification in income versus investments is so important. Okay, let's take a quick break and we'll come back and talk some more. When life brings unexpected changes, managing inherited property shouldn't add to your stress. Magnum Properties specializes in probate and trust real estate management. We handle the complexities while you focus on what matters most. From property maintenance to tenant relations, from legal compliance to maximizing value, we're your trusted partner through every step. Magnum Properties, Inc., turning property challenges into peace of mind. Call us today at 213 264 4396 or visit magnumprops.com. Okay, so the fourth idea to share with you on the issue of optionality. So, low fixed costs equals greater choice. Okay, so when your fixed costs, both in your business and in your personal life, are low, that means that for a given amount of income that you generate, you will have a greater range of choices. Okay, so on the personal side, things like your housing costs, transportation, food, insurance, healthcare, right? All of these things. So do if your housing cost currently is, let's say, $3,000 a month, right? And you've been doing well, and you feel like you could afford to increase your housing cost to $5,000 or $6,000 a month. Okay, now, is it the best option to increase your fixed expenses by that $2,000 to $3,000 a month in order to get a nicer place to live? Or is it better from a wealth building perspective to continue to live where you are and keep that additional money that you would have spent on a bigger or nicer house or apartment or whatever, and use that in order to have greater options in your investing? Now, by the way, um, it's not a straightforward decision. So let's say your current housing cost is $3,000 and you're renting. So okay, when you pay that $3,000 a month, that's it. There's nothing gained by it. Whereas, let's say maybe if you were to buy a house, okay, your monthly housing cost would go up to $5,000, but maybe on an after-tax basis, taking into account the fact that mortgage interest, at least to a certain level, is deductible on your income tax return. Typically, property taxes and insurance payments are as well. Okay, this is something, of course, you would want to clear with your tax advisor or accountant, but maybe your after-tax cost of buying a place is only $3,500, okay, or $4,000, right? So you're actually not increasing your fixed costs as much as you might think, because your after-tax position isn't your fixed cost position on an after-tax basis isn't as bad as what it looks like on a pre-tax basis. Okay, so these are the kinds of things that we should look at when we consider increasing our fixed costs. But all things being equal, our lower fixed costs give us greater optionality, and this is the trap that a lot of high income high earners get into. Is as they earn more and more, they keep increasing their fixed costs, and thereby limit their optionality. So I know for myself, usually in the fourth quarter of each year, I look at what's going on with my expenses and I see where I can adjust them down. To give you an example, I just noticed that the cost of my cell phone went up by about 25%, thereabouts, right? Don't recall getting any notification that was the case. I think you know, I signed a 1 year, not signed, but I did a 1 year agreement about a year ago, right? And that agreement probably expired, and so they just bumped it up. Well, so it's time for me to shop for a new cell phone provider. And that's part of my strategy. So I have notes in my reminders, although candidly, I thought I had a note for this, and it didn't pop last month when it should have. But in any event, um, I know once a year I've got to shop cell phone service to make sure that I'm not overpaying. Same with internet service. Same with my Sirius XM radio. Right. I know each year I need to review them to make sure that I'm getting the lowest price possible, or like in the case of Sirius XM, consider getting rid of it if it's become too costly, right? I don't have a lot of streaming services. I don't have any streaming services, but if I did, I'd be doing the same thing with the streaming services, because these things have a way of building up our fixed costs and limiting our optionality. So when we have high fixed costs and there is a drop in our income, that can create at least a temporary crisis, right? And then an opportunity comes along, and not only are we in crisis because maybe we can't meet our fixed costs, but now we can't take advantage of this opportunity either, right? So this is why in general we want to keep a low fixed cost, okay? And we should understand that financial independence is as much about controlling expenses as it is having a high income and accumulating assets. Okay, because I can tell you in my work, there are people whose ability to outstrip their income and assets is always greater than the rapidity at which their income and the value of their assets are increasing. Okay, so it's a kind of a two or three sided coin, if you will, right? We want to increase our income, we want to increase our assets, our at least our net assets, but we also want to control our expenses, and that's how we maintain, best optionality. Okay, next, human capital is the ultimate option. Okay, so our knowledge, our skills, our experience, our reputation, the relationships that we have, these all create sort of evergreen opportunity. It's why if you're a regular watcher of this show, you hear me or see me talking about relationships so often. Okay, um, there's very little that we're going to do in the realm of increasing net assets and increasing net income that doesn't involve other people. Okay, that's just the nature of business and investing today. Okay, it's not like 200 years ago we could sling our rifle over our shoulder and walk off into the wilderness and with an axe and chop down some trees and build us a log cabin and hunt for our food, or grow some vegetables and some corn or whatever on a plot of land we clear, and build wealth largely on our own, or maybe with just our family. Those opportunities are not, those sort of pioneer opportunities don't really exist anymore. Okay, so income, increasing income, increasing the value of our assets, increasing the scope of our investments. It all takes interacting with other people, and that's best done through building relationships. But from an employment and business standpoint, it's also important that we maintain our reputation for honest dealings, and we continue to look for and actually do increase our knowledge, skills, and experience. Okay, by doing so, we make ourselves more adaptable. Okay, and so when there are changes in the marketplace, we can deal with those changes more flexibly, more quickly. Okay, and in that way, maintain our optionality, or actually exercise our optionality in this case, and better maintain our income and our net worth. Okay, and that is much more so than someone whose credentials are static and who isn't out there building relationships. So if you're an employee, a W-2 employee, and I talk to a lot of people who are employees, and many of them seem to not think that building relationships in their industry is important. It's not important right up till the time when you realize you need to find another job. Okay. And I talked about this, I think a week or two ago. The best way to find a high income job is through pre existing relationships. Okay. It's not through job boards and all of that. Okay. And again, I invite you to check out that episode on my YouTube channel if this is something in which you're interested. Okay. Relationships are as important for employees as they are for business owners. Okay. Because those relationships create optionality, especially at the time when it's most crucial, where we get blindsided with a layoff or worse, get fired. Okay, so um, networks really they expand our opportunity. So I'll give you just a little example that recently came up in my own life. So last week I was looking for a contractor in Colorado to help out a client of mine. And I was trying to think, who do I know? Who do I know in Colorado? And so I went through my I keep a listing of my 150 closest relationships, business relationships, and I went through it. I just did a search for Colorado, and several names came up, and one in particular is someone that I've had some business interactions with over the last several years. Actually, hadn't touched base with him for a while. I thought, hey, I'm going to give him a call, and dialed his number. And he picked up right away. He's like, hey, Kevin, I haven't heard from you for a while. What's going on, right? And we took, 20, 30 minutes to catch up. And then lo and behold, he mentioned, among the things he mentioned that he was up to was something that I thought perhaps might be an investment that might be right for one of my clients, right? And so we talked about that, and we actually have a meeting later today to, he and his associates are going to present some information to me and have an opportunity to talk about it. Well, on Monday, I was talking to another business associate that I hadn't talked to in a little while. We were talking about, again, something unrelated. And we started talking about our primary professional interests. And I happened to mention this to her. And she's like, oh, that sounds really interesting. And so I said, well, if you like, I'll see if it's okay for me to send you the presentation and sit in on the meeting. And the answer to both those was yes, right? So here's where relationships are creating opportunity for me, potentially for my client, for another business associate, for the business associate that's working on the investment, right? So this is why relationships are so important, but it's why your network really creates opportunity beyond just kind of your balance sheet, your net worth, right? And so this is another aspect of human capital that we always need to be building, right? So investing in yourself typically will generate the greatest long-term yields over and above what passive assets alone will generate. Okay. And part of investing in yourself is creating relationships, mutually beneficial relationships with others. Okay. Finally, risk management. So, things like having proper insurance, having proper estate planning, having the right legal structure to protect your business, your assets, and all of those also protect your optionality, your flexibility, right? So if a casualty happens, God forbid you get in a car accident or you get sick or there's a fire like there was here in Los Angeles a little over a year ago, right? All of those can have a pretty devastating impact on your finances. But if you're properly insured or properly protected, have an estate plan, a proper estate plan, that reduces the risks of those casualties. It reduces the potential financial hit, and therefore keeps your optionality intact. Maybe not quite as great as it was before the casualty, but much better than if they hadn't been there. Okay. Now, I get it. Insurance is expensive these days, right? And that's why a lot of states. So, for example, Florida just went, as I recall, just I was listening to a podcast about this. They passed a lot of insurance reform that has helped tame the rising cost of insurance, and as if I remember recalling it accurately, it also has actually caused insurance premiums to drop in those things. So, uh, you know, all of these are important ways of protecting your optionality. So I have a note here from Richard. He says, "What advice do you have for someone wanting to change their work background, going from blue collar to white collar environment?" So that's a great question, Richard. In the current job environment, I'm not sure I would recommend moving from a blue collar to a white collar environment. From what I've been reading and listening to, and actually dealing with in my own practice with AI, I think the impact of AI on jobs is going to be far greater on white collar jobs than it is on blue collar jobs, right? So as I'm broadcasting this show, there's a fellow here. I don't know if you heard him walking on my roof to fix the air conditioning unit for my house. Okay, he's not going to get replaced by AI. AI is going to help him do his job more productively. So it's going to help him earn more money, but it's not going to replace him because no AI can go up on the roof and deal with the air conditioning unit up there. Okay. Now you might, well, maybe there'll be a robot someday and it'll be able to like fly up onto my roof and like a drone or something. Okay. Maybe that will happen at some point in the future, but I think we're still pretty far away from that. So like when I talk to, for example, service members who are getting out of the military and they maybe I'm thinking maybe go to college or there's that, a lot of people in the military, they actually don't want to sit behind a desk. They want to be out there doing something. So I recommend that they look at opportunities like auto mechanics, plumbing, electrical, HVAC, the kind of building trades. There is a tremendous amount of opportunity in those, historically blue collar employment, and I think they've been wrongly maligned as not being some kind of worthwhile employment. I couldn't disagree with that attitude more. These are very worthwhile forms of employment, and today the likelihood that you'll make high five to low, even mid six figure incomes in these trades is greater than it's ever been. So my advice is if you're already in blue collar work, unless there's something perhaps physically you were injured and you can't do the work any longer, I would look for ways to enhance your knowledge, skills, and experience in the field that you're already in, or in some other kind of field where it would be reasonably likely that you could move to within the trades, the blue collar realm, and continue in that vein rather than trying to get into white collar work where 2 or 3 years from now you could be experiencing what happened at, I think it's Square, who end of last week or the beginning of this week, notified the markets that they're literally laying off half their workforce and replacing them with AI. So a little bit of well, not really a tangent. This is part of the optionality discussion that we're having, that I'm presenting today. So, as an employee, this is why when I talk about, when I was just talking about human capital a moment ago, working on your knowledge, skills, experience, and reputation, continually upgrading them gives you greater optionality. The other thing I would say, just to sort of wrap up my thoughts to you, Richard, is look at how you may be able to use AI in the work that you're currently doing to enhance your productivity, and maybe show companies, your company or other companies like it, how they can do that to increase the productivity of their workforce. And in that way, you kind of are getting into a white collar environment, in the sense that maybe you would start a side gig as a consultant, taking the knowledge that you and experience you already have in your blue collar work, marrying it with kind of a white collar subject matter expert idea of being an AI implementation consultant. And maybe there's an opportunity there to marry the two that will, help you move forward more productively with your career. So, okay. So, and thanks very much for the question, Richard. So, going back to the issue of risk management, the idea behind insurance is to prevent or avoid catastrophic losses, right? Because that's what preserves your long-term strategic freedom, right? So now, as someone who had a catastrophic loss, I won't get into the the specifics of it. I don't want to bring you down, but I'm in that mode where I'm having to rebuild my finances, in order to regain greater strategic freedom. Some catastrophic losses can't be insured against, and they can't be predicted, right? So we can't, clobber ourselves over the head because we suffered, a catastrophic loss. Sometimes that's just the way life is, and then we've got to deal with them going forward. But where we can mitigate or protect ourselves from those losses through proper planning, insurance, etc., we should, right? So the final issue is in terms of risk management, and this kind of marries the last 2 points: human capital and risk management. One of the most important risk management tools we can have is building our own resilience. Okay, our ability to identify an issue, come up with solutions, and choose one that we can adopt going forward, whether it's in our professional lives, whether it's in our investment lives, whether it's in our personal lives. That ability to have and exercise our resilience is a huge key in maintaining our optionality. And it is difficult. Okay, as recently as this morning, I was on the phone to a good friend of mine, my friend Bill, to deal with something that was dropped in my plate professionally yesterday late afternoon that prevented me from sleeping well last night. And I'm all night long I'm trying to, what am I going, how should I handle this, da 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 da, right? And part of my resiliency strategy is, when I'm not feeling sufficiently resilient, to reach out to a close friend, a close colleague, and say, "Hey, can you take a few minutes to help me work my way through this and find the best response, or at least the least worst response?" Right? Resilience isn't just something inside ourselves. It's the processes that we have in place so that when we hit a difficult situation, when we confront crisis, we almost automatically do certain things to help us stay on track or to get us back on track. And this too is why relationships are so important, and why they are a crucial aspect of maintaining optionality. When we have people that to whom we can reach out to deal with the vicissitudes of life, to help us keep or stay on keep on track or get back on track, right? That's a huge part of maintaining our optionality and staying on the path to building wealth, right? So I thank you very much for joining me today. If you have any questions, comments, criticisms, links to my social media will be you'll find them in the show notes on YouTube, Spotify, and Apple Podcast. Okay. By the way, my shows post automatically after the live broadcast ends. They post automatically on YouTube. Sometimes it takes a few minutes to a few hours before they show up on Spotify and Apple Podcast. But they are there, and so you can use those links. If you want to comment publicly, that's fine. If there's something private, my email address will be there as well. You can always email me, with the caveat that I will respond. But if you're asking me for advice in an area in which I don't have competence, I'll be happy to help you find someone who does. But I'm not going to weigh in if I don't feel I have the knowledge or experience to do so. So let's see. Full slate of shows next week. Monday at 10 a.m. Pacific, Trust and Estates Weekly. Tuesday at 10 a.m. Pacific time, Business Lessons from the Military. Wednesday at 10 a.m. Pacific time, People Making Money, just like today. And then every other Thursday is my show, Jiggers' Place, where we meet, have a cocktail and a schmooze, and talk about things not related to finances. So looking forward to seeing you next broadcast. Thank you so much for joining me. Richard, thanks for the great question. I really appreciate it. And wishing you a wonderful rest of the day. And signing off as I always do, Marie, darling, you are my belle. Courage at all.